It's a sunny day, March 9, 2021. This is Ramon Vincent Team serving to you live here at CNN. Today's special coverage will focus on the valuation ratios for the retail industry in the years 2016 to 2018. We will focus on four companies A, B, C, and D. Company A is operating in three segments, namely auto, cycle, and retailing. Company B operates in two segments, investments and retail. Company C operates in two divisions, the rental division and the credit management division. Lastly, Company D operates through two segments. The retail segment comprises businesses that retail locally manufactured products, and we have the property segment. Without further ado, let's dive into the topic. The focus for today's discussion will be on total asset turnover, price earnings, and price to book ratios. To start the ball rolling, reporting live at Las Vegas, Nevada, here is Fer Refollo.
That's right, Ramon. We already got the valuation ratios of companies A, B, C, and D. But before that, let us first discuss what the ratios are all about. The gross margin ratio is a profitability ratio that compares gross margin of a company to its revenue. It shows how much profit a company makes after paying off its cost of goods sold. To calculate the gross margin ratio, we simply subtract cost of goods sold from total revenue and divide the number by total revenue. As we go along, the calculations only show the determination of the total asset turnover, since the gross margin cannot be calculated since we are dealing with very limited data. Nonetheless, the qualitative information and historical value were considered by the group in matching the gross margin. Another ratio is the total asset turnover. This helps us in measuring how efficient the company is in generating revenue from assets. The formula to get it is simply revenue divided by total assets. But making use of the limited information that we have, wherein we are given with the ROA or return on assets and net margin, the total asset turnover can be generated by employing simple arithmetic and the DuPont analysis. In the DuPont analysis, the ROA can be calculated by multiplying the company's total asset turnover ratio and the net margin. Since we already have both the ROA and the net margin, the total asset turnover is calculated as return on asset divided by net margin. Flash on your screen are the results after doing the computations. The group also considered using the average of the ratios from the previous years available, that is 2016 and 2017, since this may likely represent the ratios in 2018. It is evident that the minimal differences exist only, and coincidentally, such matching is also the same after attempting to compute the total asset turnover and ranking it accordingly. However, the group is certain that the use of averages from prior periods is the best approach in forecasting the underlying ratios, assuming that the past would closely reflect the future. Company A operating in auto and cycle, leisure and sports retailing must match with 1.4 total asset turnover and highest in terms of gross margin of 44.5%. As mentioned from management commentary, the company experienced substantial sales in all of its divisions, and truly we can say that the company enjoyed favorable returns upon investing in in-store service level and in implementing the multi-channel strategy. All of this can be proved by their sound financials, particularly from their stabilized margin ratios and working capital management. Company B, on the other hand, was quite challenged with the changes of operating environment from their investment segment and fashion retail segment. Declining demand and competition from overseas e-tailers might be the causes of the reported negative growth in sales. Despite this, management was able to control their costs and expenses which resulted in a positive growth rate in net income in 2018. Hence, the group is determined to match Company B with values that are similar to their past performance, which is 0.6 for total asset turnover and 12.5 for gross margin ratio. Such values mark the lowest among the other companies. Similarly, Company C, particularly the Credit Management Division, showed vulnerability from the new economic changes such as low consumer and business confidence. Consequently, this enabled the significant decreases in growth rates and profit ratios in both returns on assets or ROA and return on equity ROE. On the contrary, the rental division was performing well and had shored up the margin ratios. This suggests that consumers are opting to rent the products they offer. Having said this, Company C was linked to 29.6 gross margin ratio, that is, similar to the values from the previous years and the second highest among the companies. Despite high gross margin, it was partnered with 0.9 total asset turnover due to a lower net margin in 2018. Company D was equated with the highest total asset turnover, approximating 2.5, yet a low gross margin of 28.2%. The clearing of excessive inventories and product discounting had prompted a decline in the gross margin and a significant increase in inventory turnover despite having high-priced household furniture products. Indeed, with the challenges conditions that bring about low levels of consumer spending and confidence, a weak economy, and lower exchange rates for a company engaging in importing products, there is no doubt that the company is suffering. Differences may arise due to the following reasons. Management commentary may not fully capture the overall condition of the company. Each of the companies involved also has its other divisions such as finance, investments, manufacturing, and property segments. This might also have its corresponding impact on the total asset turnover, especially on the leased asset. Other factors such as changes in demand, increased competition and management of resources are matched according to the operating segment or type of retail business that the companies are involved in, and the historical values given in the case as well. The types of goods and services that the companies offer have a bearing on the asset turnover and gross margin ratios, since the determination of the aforementioned are through the accounts such as sales, total assets affected by inventory account, and gross income. We can expect that those companies that are reported to retain high assets and high value inventory would drag down the total asset turnover, while those with low assets and less expensive inventory would result in a high total asset turnover than the former. It is also important to look into the inventory turnover ratio, since this tells us the weight or portion the inventory has on the total assets. The inventory turnover would reveal how fast the company can revert the inventory into sales. Moreover, a high inventory turnover yet low gross margin is generally often due to having fast-selling and low-priced goods. Their strategy is on maintaining huge volumes to attain high sales, while those of lower inventory turnover yet large gross margin is a result of having slow selling in high-priced goods. The volume of such inventories is not usually that high as compared to low-priced goods. However, such is not always the case, since having a high inventory turnover ratio may also indicate inadequate inventory or understocking, which may have an adverse impact on the company.
Preview.
Thank you so much for CNN. We'll be right back after this commercial break.
Trusted name in news.
Writing's not that easy, but Grammarly can help. This sentence is grammatically correct, but it's wordy and hard to read. It undermines the writer's message, and the word choice is bland. Grammarly's cutting-edge technology helps you craft compelling, understandable writing that makes an impact on your reader. Much better. Are you ready to give it a try? Installation is simple and free. Visit Grammarly.com today.
This is CNN Breaking News.
Welcome back to CNN. To discuss to us about the price earnings multiple, reporting live in Cebu City, here is Erica Villamor. Erica?
Thank you, Ramon. Let us have a quick status update on companies A, B, C, and D's price to earnings multiples. The price to book multiple can be used to construct the price to earnings multiple formula. That is, by dividing the price to book multiple by the company's current ROE. This implies that price to book and price to earnings have similar factors that influence them and affect them. The only difference is that price to earnings is affected by ROE and price to book is not. In this problem, we use the relationship between price to earnings and a company's ROE to determine the price earnings of these four companies. If a company has low ROE, its price to earnings is high and vice versa. Given those assumptions as basis, we can now see that company C with the highest ROE has a 10.8 price to earnings multiple. It was mentioned by their management that they are experiencing tough economic conditions, which brought their 2018 ROE down compared to the previous year. Company A, which has the second highest ROE among the four, also got the highest price to earnings multiple. A's management made a commentary about having solid sales growth in all divisions, but costs are also increasing. This was evidenced by its decrease in its net income growth. Company D with the third highest ROE has a price to earnings multiple of 15. Company D previously mentioned that their performance has been affected by challenging trading conditions due to increased competition. Consequently, Company D had a huge decrease in its ROE and net income growth rate for 2018. Lastly, Company B with the lowest ROE has a price to earnings multiple of 11.1. The huge gap between its ROE and price to earnings can be explained, according to its management, by its increased sales and profit, thereby boosting its net income growth to 68.4%. Since it has a low ROE, it is likely that it will have a high price to earnings multiple. But Ramon, let us remember that any differences may be caused by the following reasons. Number one, the four companies in retail industry do not have the same market, okay? Each company has different segments or divisions in different markets, operating in different markets. We have sports division of Company A, the leisure division of Company A. We also have investment and retail of Company B. We also have rental and credit management of Company C. And for Company D, we have retail and property division. Number two, Ramon, would be that each company has different business strategy. Having to be in the same industry doesn't have to mean implementing the same strategy as well. Each one of them have different ways of dealing with risks and conditions brought about by changes in the market, the industry, and the economy as a whole. Lastly would be that each company has different growth rates. This can mean that financial position and performance information can vary among four companies because of four different growth rates, mainly because they are operating in different markets, so differences may arise. So that is all, Ramon. That is all the updates of companies A, B, C, and D on their price to earnings multiple. Back to you, Ramon.
Thank you so much, Erica. To match the price to book multiple for the given companies, here is Melinde Boyan live in Bacolod City.
Up next, breaking news. This is Melange Didipuyan reporting. Today is the day that we will be revealing the companies behind those price to book multiples. 4 companies were chosen and we will be identifying which is which. Given the fact that there is limited information in the case, we will not be using the original formula in computing the price to book multiple. Instead, we will be utilizing the formula that was already mentioned in the previous discussion. In the previous discussion, recall that Miss Erica focuses on the price earnings multiple. So, modifying that formula, we will arrive at the price to book is equal to price earnings multiplied by ROE. So using this formula, we arrived at the following results. So for all firms, price to book multiple is computed as follows. Price to book is equal to price earnings multiplied by the ROE. For company A, we have 22.9 multiplied by 14.5%, so we have 3.3. For company B, we have 11.1 multiplied by 5.6% is equal to 0.6. For company C, we have 10.8 multiplied by 19%, so we have 2.0. For company D, we have 15 multiplied by 12.4%, so we have 1.9. So after computing the company's respective price-to-book ratio, the firm column in the table was filled up accordingly. So the price-to-book multiple of 0.6, 1.9, 2.0, and 3.2 belongs to firm B, D, C, and A respectively. The price-to-book multiple gives an indication of how investors regard the company. Companies that are well regarded by investors, which means that they are perceived as low risk and high growth, have high price-to-book multiple. Typically, price-to-book multiple exceeds 1.0, which means that investors are willing to pay more for the stocks than the accounting book values of the stocks. Further, price-to-book multiple is greater than 1 if firms with positive abnormal ROE are able to invest their net assets to create value for shareholders. So, among the firms, only firm B has a price-to-book multiple of less than 1.0. This is because of its relatively much lower ROE than other companies. Although company B has a positive tone in the management commentary, investors see it in a different way. This may suggest that firm B is unable to generate returns greater than the cost of capital. Alternatively, firms A, C, and D price-to-book multiples suggest that their companies are able to invest in positive value projects or they have ROEs that exceed the cost of capital. Particularly, firm A has the highest price-to-book multiple of 3.2, and it might be linked to its investment activities stated in its management commentary. Firm C has the second highest price-to-book multiple of 2.0, which may be attributable to its management commentary that underscore their resilience and strength despite tough economic conditions. That ends my report. Back to you, Ramon.
Preview. Thank you so much, Ms. Dibuyan. Indeed, ratios are important tools that will help us to evaluate a company. Nonetheless, thank you so much everybody for tuning in live here in CNN. We hope to see you next time. This is Ramon Vincentiman and team, serving you with honesty and truth.
This is CNN, the most trusted name in news.